bar is above the high of the previous bar and the low is below the low of the previous bar, then the current bar is an outside bar. Outside bars are complicated to read because both the bulls and the bears were in control at some point within the bar or the prior bar, and there are many subtleties in their analysis. The increased size of the bar means that bulls and bears are willing to be more aggressive, but if the close is near the middle, it is essentially a 1 bar long trading range. In fact, by definition, since an outside bar totally overlaps the prior bar, every outside bar is a part of a trading range, which is 2 or more bars that largely overlap. At other times, they can act as reversal bars or trend bars. Traders must pay attention to the context in which they occur. Traditional technical analysis teaches that outside bars are setup bars for a breakout in either direction, and that you should put an entry stop above and below. Once filled, double the size of the unfilled stop and make it a reversal order. However, it is almost always unwise to enter on a breakout of a 5-minute outside bar, especially if the outside bar is large, because of the greater risk that the distant stop entails. Sometimes they occur when you are looking for a major reversal and you are very confident that there will be a large, strong reversal. When that happens, it makes sense to enter as soon as the bar takes out the extreme of the prior bar. If you are less certain, you can wait for the bar to close and then enter on the breakout of the outside bar. If you did enter on the breakout of an outside bar and the protective stop is too large, consider using a money stop like 2 points in the E-mini or trading fewer contracts. Since an outside bar is a 1 bar trading range and it is better to not buy at the top of a sideways market or sell below it, it is usually best to not enter on a breakout of the bar. 155. 156. Price action. Outside bars can be reliable entry bars if the bar before them was a good signal bar. For example, if a trader is looking to buy at the bottom of a bear swing and the market forms a strong bull reversal bar but the next bar trades below the bar, the trader should consider leaving the buy stop in the market. If the bar suddenly reverses back above the bull signal bar, the buy stop will be triggered and the current bar will become an outside bar and an entry bar. In general, traders should not enter a reversal trade on an outside bar unless the bar before it was a decent signal bar. Sometimes you have to enter on an outside bar, not on its breakout, because you know that traders are trapped. This is especially true after a strong move. If an outside bar occurs as the second entry in a strong reversal from a trend line break or trend channel line overshoot, it can be an excellent entry bar. For example, if the market just sold off below a swing low for the second time and reversed up from a trend channel line overshoot, you are likely looking to buy and you keep moving a buy stop order to 1 tick above the prior bar's high until you get filled. Sometimes the fill will be on an outside up bar. This is usually a good reversal trade and it is due to strong buyers. If an outside bar is in the middle of a trading range, it is meaningless and should not be used to generate trades, unless it is followed by a small bar near the high or low of the outside bar, setting up a fade. An outside bar in a trading range just reaffirms what everyone already knows, that both sides are balanced and both will sell near the top of the range and buy near the bottom, expecting a move toward the opposite end of the outside bar. If the market instead breaks out in the other direction, just let it go and look to fade a failed breakout of the outside bar, which commonly happens within a few bars. Otherwise, just wait for a pullback. A failed breakout that fails is a breakout pullback setup. If the bar after the outside bar is an inside bar, then this is an EOI pattern, inside outside inside, and can be a setup for an entry in the direction of the breakout of the inside bar. However, take the entry only if there is a reason to believe that the market could move far enough to hit your profit target. For example, if the EOI is at a newsing high and the second inside bar is a bear bar that closes near its low, a downside breakout could be a good short since it is likely a second entry. The first entry probably occurred as the outside bar traded below the low of the bar before it. If it is in barbed wire, a tight trading range, especially if the inside bar is large and near the middle of the outside bar, it is usually better to wait for a stronger setup. Wienerwirth trend outside bar occurs in the first leg of a trend reversal and the prior trend was strong. It functions like a strong trend bar and not a trading range type of bar. For example, in a bear trend, if there is a strong reversal up, traders might start looking for more of a rally. Many traders will be looking to buy above the high of a higher low, and fewer traders will short below the low of the prior. Outside bars. 157. Bar. Bulls are especially aggressive. They will buy below the low of the prior bar instead of waiting to buy above its high, and they will keep buying for the next several minutes as more and more traders see that the bulls have taken control of the market. This will make the bar extend above the high of that prior bar. Once it does, it becomes an outside up bar, and those bears who just shorted below the low of the prior bar will likely cover and not be eager to short again for at least a couple of bars. With very few bears and many aggressive bulls, the market is one-sided and likely to go up at least for a bar or two. Everyone suddenly agrees about the new direction, and therefore the move will have so much momentum and extend so far that it will likely get tested after a pullback, creating a second leg up. This higher low, and not the actual bear low, is the start of the up leg because it is when the market suddenly agreed that the next leg is up and not down. There will usually be two legs up from the bottom of the outside bar. Although the swing up will appear as three legs up from the actual bear low on the chart, it functionally is only two legs up, since the market did not agree about the bull move until the higher low formed rather than at the actual low. This is where it became clear that the bulls had seized control. Why ease the move off and strong? The old bears who shorted below the low of the prior bar, in what they thought would be just another bear flag, became trapped. Then their entry bar quickly reversed to an outside bar up, trapping the bears in and trapping the bulls out. Many bulls were trapped out because they don't like entering as outside bars are forming, since many outside bars just lead to trading ranges. Invariably, the market will trend up hard for many more bars as everyone realizes that the market has reversed and they are trying to figure out how to position themselves. The bears are hoping for a dip so they can exit with a smaller loss, and the bulls want the same dip so they can buy more with limited risk. When everyone wants the same thing, it will not happen because both sides will start buying even 2 or 3 tick pullbacks, preventing a 2 or 3 bar pullback from developing until the trend has gone very far. Smart price action traders will be aware of this possibility at the outset, and if they are looking for a two-legged extended up move, they will watch the downside breakout of that bear flag carefully and anticipate its failure. They will place their entry orders just above the high of the prior bar, even if it means entering on an outside bar up, especially if it is the entry bar for the shorts. If you think about this from an institution's perspective, you will want the bear flag short to trigger so that there will be longs who are trapped out and who will chase the market up, and also new shorts who will be trapped in and will have to cover if the bear breakout fails. This is an ideal situation for the institution that wants and expects a rally. So, as an institution, what can you do to contribute to this? Don't buy aggressively until after the trap. In fact, you try to create the trap. 158. Price action. By selling until the short entry is triggered and then you buy aggressively as all those bear traders get short and the longs exit with losses just below the low of the prior bar. You take the opposite side of their positions and buy heavily below the low of the prior bar. Once you've trapped them all, you can buy aggressively all the way up. They will chase the market up once they see the trap, and this will propel the market upward with everyone in agreement that the market is heading higher. The single most important thing to remember about outside bars is that whenever a trader is uncertain about what to do, the best decision is to wait for more price action to develop. Figure 7.1. Outside bars. 159. Traders have to pay careful attention to the price action that led to them. In Figure 7.1, Bar 1 was an outside up bar in a strong bear trend, so traders would be looking to enter only on a downside breakout. You could either short below bar 1 or wait to see what the breakout bar looks like after it closes. Here, it was a strong bear trend bar, and trapped longs will likely exit below such a strong bear trend bar. Because of this, it makes sense to short below the low of that bear bar. Bar 5 was an outside down bar, but the market was basically sideways with lots of overlapping bars, so it was not a reliable setup for a breakout entry. The inside bar that followed it, EOID, was too large to use as a breakout signal, because you would be either selling at the bottom of a trading range or buying at the top, and you only want to buy low or sell high. 160. Price action. Figure 7.1. Deeper discussion of this chart. The market broke out below yesterday's low in Figure 7.1, and the first bar was a bear trend bar and the first bar of a trend from the open bear trend. bar 1 and the bar before it formed the first pullback, and there is usually at least a scalp down after that first pullback. There was a two-legged pullback to the moving average at bar 3, which was also a 20 gap bars short setup. Figure 7.2. Outside bars. 161. Because both the bulls and bears were in control at some point during the bar or during the prior bar, so the movement over the next few bars can have further reversals. In figure 7.2, bar 1 was an outside bar that formed an inside-outside-inside EOI pattern. The bar 2 breakout of the inside bar following bar 1 failed, which is common, especially when the inside bar is large. This is because longs were forced to buy near the top of the EOI pattern, which is a trading range, and that is never a good thing, particularly when the market is falling. Bar 2 was a small bar near the top of the trading range, which is a good area in which to look for a short entry. Since traders expected bulls to exit with a loss below the low of bar 2, their entry bar, they shorted at one tick below bar 2, which was a failed EOI breakout at the top of a trading range. Since the EOI bars were so large, there was plenty of room below bar 2 for at least a scalp down. Bar 4 was almost an outside-up bar, and in trading if something is almost a reliable pattern, it will likely yield the reliable result. Bar 4 was the third bull trend bar in the prior 5 bars, and therefore was reversing up from a third push down. 162. Price action. Figure set range and smallest tails, indicating that the bulls were gaining strength. Bar 5 was an outside bar followed by a small inside bar near its high. Again, this yielded a great short with minimal risk, especially since the inside bar was a bear bar. Deeper discussion of this chart. The first bar in figure 7.2 broke out above yesterday's high and the breakout failed. The bar became a strong bear trend bar and it set up a trend from the open short. Bars 8 and 9 form a small double bottom, which waste not the downward momentum that traders were expecting after the bar 7 bear breakout bar. This loss of downward momentum was followed by the bar 10 double bottom pullback long. Bar 9 was also a high 2 long and 2-legged pullback from the rally up from bar 4. This formed a higher low on the day after the break of the bear trend line, setting up a possible trend reversal. Figure 7.3. Context. Outside in context. In figure 7.3, the doji inside bar after bar 1 was not a good short signal bar since there were 3 sideways bars and bar 1 just reversed the bear bar before it. The odds were that the market would go sideways or up for at least a bar or two after that opening reversal, especially with a relatively flat moving average. There was room up to the moving average for a scalp, and it is best to buy above bull bars. The inside bar was and therefore a type of pullback after the reversal up, so buying above its high and above the bar 1 high was reasonable. A trader could place a buy stop 1 tick above bar 1, and when bar 2 traded below the inside bar it was wise to keep the stop in place. The logic behind the long remained, and now there were trapped shorts who had made the mistake of selling below a weak signal bar and would cover above the signal bar. This made entering long on bar 2 as soon as it went outside up a good trade. As long as the bar before the outside bar is a decent signal bar, entering on the outside bar can be a sensible trade. Bar 3 was a reversal bar near the moving average and an acceptable short, but it was small compared to the bull bodies of bars 1 and 2, so the market might form a higher low and then rally some more, which often happens when there is a strong outside trend bar at a possible trend reversal. Therefore, whether or not 164. Price action. Traders shorted below bar 3, they had to be ready to buy a higher low, and the small bully 2 bars later was a good signal. Bar 4 was an outside bar, but the market was sideways for 5 bars. Therefore it was just part of the trading range and not a signal bar. Bar 5 was an even larger outside bar, forming a new or outside-outside pattern. This is usually just a larger trading range. Here, the bar had a large bear body and closed below the low of bar 4. Traders who mistakenly shorted below the bar 4 outside bar were trapped. In general, it is not good to short a breakout of a trading range when many of the bars in the trading range are relatively large and have big tails, because the odds that the breakout will fail are high. The small bull doji bar that followed was a good signal bar for a failed reversal long. Bar 6 set up a short following the breakout of the top of an outside up bar. Bar 7 broke to a swing high and reversed down as an outside bar that closed on its low. This is an instance where there were trapped bulls and a strong bear reversal after a rally. However, this was a trading range day, and any time a leg lasts more than 5 bars, traders will be looking for a reversal buy low, sell high, on trading range days. Although it was acceptable to short as the bar traded below the small bear bar before it, it would be better to sell below the low of bar 7, since you would be shorting below a strong bear reversal bar as it is getting some follow through. Deeper discussion of this chart. The market broke out to the downside with a large gap down and a bear trend bar in figure 7.3, but instead of trading down and creating a trend from the open bear trend, the breakout to the downside failed and the market reversed up into a trend from the open bull day. Bar 2 was an outside bar up and a possible low of the day, since the market was reversing up from a big gap down. This means that it was on bar 2 that the market decided that the trend was up, and therefore it should be considered the start of the move up. Although bar 3 was a low too short, it was seen by the market as just a low one because it was the first pullback in the move up from the bar 2 start of the rally, and therefore likely to just lead to a higher low. Traders were expecting it to fail, and it does not matter whether you see the move up as a failed low 2 or a failed low 1, because both are good buy setups in a possible bull trend. Bar 5 was a breakout of a barbed wire pattern. Most breakouts from barbed wire fail, so traders should look for the fade setup. Barbed wire is an area of intense uncertainty and two-sided trading. Bulls buy aggressively near the low and stop buying near the high. Bears sell aggressively near the high but stop shorting near the low. There are large buy and sell programs at work here, as can be seen by the good volume being traded during each bar. Both bulls and bears are comfortable trading here, and if one side is able to. Figure 7.3. Outside bars. 165. Briefly overwhelm the other and create a breakout. Usually the magnetic effect of the pattern will pull the market back. Once the market broke to the downside, the bulls, who were happy to buy higher in the middle of that trading range, were even happier buying lower. Also, the bears, who were happy selling at the top of the trading range, would be quick to buy back their shorts if there was not immediate follow through on the breakout. These factors led to the high probability that the breakout would fail and get pulled back into the barbed wire, as was the case here. Sometimes the market then breaks out of the other side, and other times the trading range continues. Eventually there will be a move out of the pattern. The first bar of the day and the first several bars often foreshadow what the next few hours, and often the entire day, will look like. The day started with a 2-bar reversal, and then a doji, which is an intrabar reversal, and then an outside up bar reversal. There was tenabia reversal and several small bars with tails, indicating uncertainty. Multiple reversals, big tails, and uncertainty are all characteristics of trading range days, which was what the day became. With that suspicion early on, traders were more comfortable placing trades in both directions, scalping a larger portion of their positions, and less inclined to swing. At 11:25 a.m. Pacific Standard Time, there was a bull outside bar that formed a 2-bar reversal, and therefore, created a buy setup. This pattern also formed a micro double bottom with the doji bar before it. 166. A bar can sometimes be a reasonable entry bar. In figure 7.4, bar 3 was an outside up bar and an acceptable entry bar because it was a reversal up after a 2-legged correction in a strong bull trend, and there was a bull trend bar a couple of bars earlier, showing strength. Traders would buy as soon as the bar went above the high of the prior bar, but it would be safer to wait a few more ticks until it went above the high of that bull trend bar from 2 bars earlier. Buying above a bull bar usually has a higher chance of leading to a profitable trade. Finally, traders could wait for the close of the outside up bar to see if it closed near its high and above the prior bar, which it did. Once they see that strength, they could buy above the high of the outside bar. Bar 6 was an outside down bar and 5 of the 6 prior bars had bare bodies. It closed on its low, and aggressive traders could have shorted below it after such bear strength, especially since it trapped bulls into buying the old bull trend, which no move over. Deeper discussion of this chart. The market in figure 7.4 broke out below the trading range of the final Haurof yesterday. The first bar was a bull trend bar, but it had a large tail on the top, indicating that the figure 7 enough to close the bar on its high. You could either buy above this bar or wait. The second bar was a setup for a breakout pullback short for a trend from the open bear day. The move down to bar 1 was a parabolic sell climax and therefore a possible low of the day. Since the selling was strong, it would be better to wait for a second signal before buying, and it came 8 bars later in the form of a higher low and a failed breakout of a bear flag. The sell-off to bar 3 broke a major trend line, alerting traders to short a test of the bar 2 high. The bar before bar 3 was a moving average gap bar buy setup in a strong trend, so buying above it, even with an outside up bar, was a good trade. The move down to a 20 gap bars setup almost always breaks a trend line, and the move up from the bar usually tests the high of the trend with either a higher high or a lower high. If there is then a reversal down, it usually leads to at least 2 legs lasting at least 10 bars and often a trend reversal. Bar 3 was also the second bar of a 2-bar reversal with the bear bar before it and with the bear bar from 2 bars earlier, so many bulls bought above the high of bar 3. Bar 4 was a large bull trend bar climactic that formed a higher high, and it was followed by a strong bear inside bar that was the signal for the short. Traders were expecting 2 legs down from such a strong setup. As such, smart traders will be watching for the formation of a high 1 and then a high 2 and readying themselves to short more if these long setups fail and trap the bulls. Bar 5 was a short setup for a failed high 1, and bar 6 was a great bull trap. It was a failed high 2, and the long entry bar reversed into an outside bar down, trapping longs in and bears out. This outside bar acted like a bear trend bar and not just an outside bar. Because it was an outside bar, the entry bar and its failure happened within a minute or 2 of each other, not giving traders enough time to process the information. Within a bar or 2, they realized that the market in fact had become a bear trend. The longs were hoping for a 2 or 3 bar pullback to exit with a smaller loss, whereas the bears were hoping for the same rally to allow for a short entry with a smaller risk. What happened was that both sides started selling every 2 or 3 tick pullback, so a 2 or 3 bar rally did not come until the market had gone a long way. Note that the high 2 long was a terrible buy setup because 5 of the 6 prior bars were bear bars and the other bar was a doji. A high 2 alone is not a setup. There first has to be earlier